Let's start with you in the equity markets. They seem to be relatively calm despite that talk about maybe some kerfuffle down in Washington.
Yeah, this is really interesting, and I think it's one of the most frequently asked questions that we're getting from our investors. Why is volatility muted? Why are we not seeing any stresses within the equity markets? And I think there's a couple of explanations for this. So the first one is when you look at the breadth of the equity market rally that we've seen, it's really only 7 stocks are driving 80% of the year-to-date gains. So this is very concentrated. This is very idiosyncratic. Another way to look at it is you have about 10 companies that are driving 25% of the free cash flow generation within the U.S. market. So this is a story about the companies that are really well run as opposed to a breadth and depth of this rally.
So, Lizanne, what about that? Does that narrowness of the rally, if we can call it that in the stock market, does that make you nervous?
Well, it doesn't suggest as healthy a market as if you had, the soldiers at the front line and not just the generals at the front line. I think there's a little bit of muscle memory and a knee-jerk move that goes back into names like this when people think back to that group of stocks. Many of the same ones represented almost a defensive place to go during the worst part of the pandemic. But of course, what it represented fundamentally at that time was those represented the only ecosystems in which we were living when everything was shut down. I think this time it's a bit different. Chris talked about the large size and liquidity and cash generation of these companies. You can also see the dominance of their outperformance really kick into high gear when we saw the failure of SVB Bank and the ripple effects. So I think that really was the push there. You can have an environment like that last a while, and it doesn't necessarily have to be calamitous. There are times where you can see some catch down by the big dominant names while you're seeing improving breadth and better participation on the way back up. That's a bit of what was going on last fall when the market had its low. But I think concentration risk in terms of what is the manifestation actually for investors, I think investors should be mindful of not chasing that and ending up with too much concentration risk.
So, Chris, the equity markets can't get too far away from earnings, and we're well into earnings now towards the end of this season. And we looked at our elves, that we have 24 elves, of which we have one from Citi, actually. And they're projecting overall, I think, $206 at the end of the year in earnings per share, which is down about 8% from last year. Where are you on that projection?
We're very much aligned to that we started this year looking at about a 10% earnings contraction. We're now in the ballpark of about 8 to 10%. And I think when we look at Q1 earnings, they were certainly better than feared, which is why we could see some reduction of that number. But I think what we have to keep in mind is when we look at the U.S. equity market, we have 7 out of 11 sectors that are already in a profits recession. When we look at what the Fed has done already, the 500 basis points of rate hikes, the quantitative tightening, the stresses in the banking sector that are going to lead to tightening of credit conditions, this is something that has us very cautious. It's more difficult for companies to be profitable in this environment. It's more challenging on the consumer. And the idea that this isn't going to flow through to corporate earnings in a more material way is something that we just don't believe. So playing a little defense here and expecting some downside is what we're advising our investors.
Listen, I must say, when I listen to Chris, I'm reminded of something you said on this program before, which is we may not have an overall recession, we're having a rolling recession, as we talk about the 7 of the 11. Is that still your position? Are we ever going to have a real recession across the board, or is it just going to be one segment after the other?
I think more likely than not we'll have an officially declared recession by the NBER. Of course, that happens well down the road in terms of just the process of making the announcement and then backdating to when it started. I think what had been a missing ingredient for a traditional recession until the start of the banking crisis was the absence of a credit crunch. We had the asset crunch part of this, but we've not had a credit crunch. It's certainly a lot harder to bank on that at this point. We certainly have a credit contraction likely to turn into a credit crunch. And I think that ultimately takes down the segments of the economy that had a revival at a later point in time because of just the rolling nature of the pandemic, the goods orientation on the demand side initially, even within inflation metrics. Many of those areas like housing related, the factory sector went into recessions. We've just had the offsetting strength in services, and that's a larger employer, and that's helped keep the labor market afloat. But I think that is set to falter, and it's unlikely that a recovery in those areas that already have gone into recession will be sufficient enough to offset that. So I think it's a better shot that this ultimately goes in the record book as a recession at some point.